Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will discuss the best trading strategy for high inflation periods.
Hello everyone, my name is Radovan Vojtko, I'm CEO of Quantpedia. In today's video, I would like to discuss the role of interest rates and inflation in trading strategies. So we are currently living in the times when the inflation is higher than everybody expected a few years ago. This inflation and of course the interest rates that the Fed has to increase have impact on trading strategies. The question is how big the impact is. We have a research paper which deals with investing in inflation and inflation regime. This paper is written by about Swinkles and Tim van Vliet, and it's a very nice paper, and it's showing what is the performance of investing just in equity index during different regimes, so during the deflation, low inflation or high inflation regime. As we can see, equities has a real trouble in high inflation periods, while the nominal return of the equities may be high, so 60% equities, 40% bonds, but return of the equities is nearly comparable. So this portfolio has a problem in high inflation periods when the nominal return may be positive, but real return is usually negative due to high inflation. The question is how the trading strategies react in these high inflation periods. So for something like that, there is another paper written by Ginsberg, Ma, Liang, and Schwert. They touched this subject and they made a mention of both the past factor research, and they found that significant part of published papers and developed models are usually exposed and they are fit to low or zero interest rate. So they tested 153 anomalies and they tried to measure the sensitivity to interest rates. So it means they measured also sensitivity to inflation, and out of them, less than half are robust anomalies, but there are a lot of anomalies that are not robust. So it means they have the performance, or they had the performance only because there was low inflation and low interest rate period. The question is what we can do with that. So we touched this subject in our own article. What's the best factor for high inflation period? We were looking on multiple different periods with a high annual rate of inflation. So we used the data from over 100 years. There are three notable periods. The first one is during the First World War, then there is a period during the Second World War, the period with the oil crisis, and the current period. Current period is the fourth period. What is the performance of the factor strategies during periods, and what is the best factor for high inflation period? The first that we can check is what is the performance of the market portfolio. Market portfolio is simply performance of the equities. As you can see, the average performance, so there is a high spread between the best and worst periods and best and worst years. Average performance of the equities is not extremely high, it's only around 3%. So that's the nominal performance. So if we check the performance, what was the inflation during those periods, the inflation was significantly higher. Buying the stocks is not the best hedge for high inflation periods. So what are the safe haven assets during the high inflation years? So we tried to make multiple portfolios. The first one was to check what is the performance of the utilities. Those are the companies that are usually exposed negatively during the period of inflation, and their performance is really not high, only 2%. The best performing portfolio is in energy industry. The energy proxy portfolio performed well, and it has performed around 6%, but that's not the winner. What is interesting is we can check what is the performance of the tech portfolios or tech stock. Prices of the tech stocks do not have a nice performance. They usually lose or lose money during the high inflation period, as it happens at the current time. So we can see that the tech stocks are not very good hedge or not very good portfolio for high inflation period. We can check two of the fama friend factors, small minus big and high minus low, so the small stocks and value stocks, and we can check how they perform. So first we can check the small stocks. The small stocks perform positively, but still usually lower performance than the average performance and the average inflation. On the other hand, we have the value stocks. And the average annual performance of the value portfolio was over 9%, so nearly 10%. So surprisingly, or maybe not surprisingly, the value stocks are really a hedge for high inflation periods. So those are the stocks that perform the best. As we can see in the current situation, so in 2022, it's the year of the value, and it's also a year for the energy stocks. Long-term reversal factor is also one of the fama friend factors. The yearly performance for long-term reversal factor is again 10%. It's a factor which is very similar to value stock. So that's also interesting performance. And what is the performance of the momentum? Momentum factor has also significantly positive performance over it. It's very interesting performance. These are the results of the basic portfolios, and the factor portfolios. We in Quantpedia, we understand that interest rates and inflation, they can have a really significant impact on the performance of trading strategies. Because of that, we have two special reports in Quantpedia Pro. First one is called Inflation Commodity Phases Analysis. What does it mean is you can select any trading strategy, or you can upload your own trading strategy into Quantpedia Pro. And this report will give you a glimpse into the behavior of your portfolio in different inflationary phases, defined through the lenses of commodity market movements. It will use historical data and it will show you how is your portfolio sensitive to inflation and commodity and to the spikes in commodity prices. Second important report is fixed income phases analysis. Also offers a glimpse into the behavior of your portfolio, but in different interest rate phases. We check what is the performance of US 7 to 10 year treasury market, how the treasury market moves, and how is your portfolio sensitive to movement in interest rates. So thank you very much. I hope you like this video. I hope that I showed you it's very important to understand how the trading strategies behave during the inflation period and during the different regimes or different interest rates market regimes. Thank you very much for your attention.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.